The Sydney property market.
You're kind of my Sydney property guru anyway.
I only hear that. My rent has gone up. Could put downward pressure on housing demand. Fixed. Construction costs aren't going to rise that much over the next couple. Buy your apartment, move into it, live in it, make some equity, sell it, move into a house.
Get out of it, CGT free, happy days.
Yeah, move into a house. So yeah, that opportunity does exist. The Sydney property market, one of my favorite topics to talk about. Let's go through what is happening in Sydney right now and what's going to happen over the next 6-month period ahead. As mortgage brokers in Sydney working with lots and lots of Sydney clients, we get a little bit of a feel, particularly in our day-to-day life as to the way our clients are feeling, interacting with real estate agents, and the on-the-ground intel that we receive from them. So let's share some of the soft anecdotal data that we get, that informational side of things, to our audience to help them make decisions as to what's going to happen to Sydney right now. We're going to go through what it's looking like right now, the stories that we're hearing. We're going to go through high-level data metrics, and we're going to talk about both the positive factors that will drive more growth in Sydney, and then the negative factors that are also there and risk factors that exist for the Sydney property market too. Let's get into it, Kurt. How are you, man?
Pretty good. And like you say, we get to interact and speak with a lot of people that are either live in Sydney, buying in Sydney, upgrading in Sydney, investing in Sydney. And yeah, you're kind of my Sydney property guru anyway. You seem to have very good on the ground feel. You're out and about a lot at development sites and things. So yeah, what's your bit of overall feel for it to kick off?
Oh man, if I go through my phone, I have probably in the last week, maybe the number one person who calls me other than clients is real estate agents. Quite often friends, people in the industry, networks, other mortgage brokers. So we obviously have a very, very good pulse of what's happening around. I'd say it's a very scattered market at the moment. And also it's a bit hard to tell because it's the first week back after the winter school holidays. And the winter school holidays marks a little moment in the Sydney property market where it just dries up. Everything gets really, really slow. So slow that some people start to panic and be like, whoa, the house is falling in. It's quite scary out there at the moment. That's what it was a little bit like in that June month. But that happens almost every June.
Yep.
It is June, July, particularly the winter school holidays. Maybe I'm wrong about this, but it felt particularly chilly too. And just like, look, I am
not going out to open homes.
A little bit, yeah. So there's been less stock available, which is quite normal. Listings don't pop up at this time of the year. We have like a seasonal lull and less people looking and all the data metrics that you have. Like I have a suburb metric on my phone for the area that I live in, and it just shows a huge decline and a huge spike in the last 5 days in terms of the people looking on their real estate domain apps. And I'm on real estate domain, always looking every sort of day over the last
decade.
Maybe 3 years. Decade. So yeah, I can see more things popping up there as well. So so it's hard to say as of right now, but it's clearly picked up a lot in the last 4, 5, 6, 7, 8 days since people have gone back to school. The first weekend of open homes, I've spoken to a number of people in the East and they've said, the energy's back. Wow. I was getting a little bit worried thinking it's going to be a very, very, very slow spring, but the energy is back. But it's only been 1 week of data and you could see it in clearance rates a little bit. They did take up a bit. So meanwhile, out west, it's strong. The affordable markets of Sydney, I don't even know if you call them affordable, but like anything, 10, 15 kilometers west and beyond, like maybe the sub $1.5 million median house price, those markets are doing really, really well. There's a lot of demand there. The flight to affordability into Sydney is strong. So you're seeing a little bit of a shift. The market is shifting out west, which will probably drive any growth that kicks in. It'll probably be more dominated by cheaper end markets of Sydney. And it is at the moment, and it will likely continue. Meanwhile, the top end of the market will probably be a little bit weaker. But yeah, this inflation data just came out, so maybe it will be maybe it will
more
tick back
widespread.
Up. Maybe it will tick back up. Maybe there'll be a bit of confidence that comes back associated with rates won't go up. And if they don't, that could trigger a little bit of momentum for the spring selling season, the busiest season of the year. We're about to hit it. The Christmas time of property is now. It's September, October, November, that's when it gets really, really busy, and August is the start of it. We are entering that period now. And yeah, it's a little bit patchy. West, really strong. East, not so strong, but picking back up because it is the first week or the second week.
Yeah, I'd say based on the discussions I've been having with people, there it would seem to be mainly owner-occupier driven as well. I think I'm seeing less investment activity or people looking to Sydney to invest just given high prices and a stretched affordability. But yeah, it seems to be more owner-occupied upgraders, people looking to get into the owner-occupied market, swap an apartment for a house, those kind of things, is where the majority of the demand is coming from.
Yep. There's a lot of Sydney investor activity though as well. Like the data's suggesting it. It's just a lot of Sydney-siders are opening their minds up as to where to invest. Maybe the sub-regionals around Sydney, perhaps Perth, perhaps Brisbane, not Melbourne. That just seems to be a little bit of a basket case at the moment. People aren't looking there. At the moment, investors are running away, not going towards. But you can see Sydney-siders investing.
Just not in Sydney.
Yeah, there's probably a more openness to investing outside Sydney at the moment. So that is something that's there at the moment. Current stock on market levels, a little bit higher than average, in and around there, but nothing to be alarmed by. Vendor discounting comes down a little bit over the last 12 months. So it suggests that vendors are selling their homes at decent prices. They're not having to discount it that much. Price level is pretty high. We're at peak Sydney property prices with the peak cash rate in 15 years as well. So, affordability, you combine that highest house price with highest interest rate in 15 years, you have affordability very, very low.
Yeah.
Extremely low, pointing to danger signs. So that's the current sort of stuff. But I wouldn't mind pivoting to some of the risks that I see. I don't want to sound downbeat in this podcast, but some of the risks that I see is the rental market is now in reverse.
Softening, yep.
Softening, and asking rents are down 2.5% this quarter, while they have ratcheted up over the last 2 or 3 years.
Yep.
And this has really changed. This has really helped buffer any rate increase to Sydney housing. The rate increase has just been matched with a rental increase. So if you're making the cost of housing go up, but the income of housing go up with it, then really net, it doesn't actually change all that much. That's what's happening. But now rents are coming down, which should feed into the cost of mortgage coming down as well, because it's a big driver into the CPI basket. But the cost of rents is starting to come down, which is a little bit of drag on house prices or the value of house prices if that continues, 2.5% per quarter. If that happens for another 2 or 3 quarters, then you're wiping out a pretty big, significant chunk of rental inflation, and that could put a bit of pressure onto markets.
Yeah, particularly if rates stay flat, you're basically the gap between price, asset values and the yields that you're getting, is going to collapse a little bit if that trend continues. So, yeah, for an owner-occupier, maybe not as much of a concern, but just overall on how do you value the asset?
Yeah.
If it's producing less income, then that's downward pressure.
Of course. Have you spoken to anyone about rents in Sydney? Has anyone given you any intel in the conversations that you've had? Anyone talk about it? Their rental prices? I only hear that. My rent has gone up.
Yeah,
Sucks.
Not really. Like I'm renting at the moment, so I'm not really too concerned with anyone's rent but my own. To be brutally honest, my rent hasn't really gone up. So I don't know how to describe it. I hear a lot of people complaining about rent, but I don't. My actual feel for how much has your rent gone up month to month, or not like lease to lease, and in percentage terms, what does that look like? I don't have a good feel. I find the anecdotal evidence to be misleading.
Yeah, I would say that. Misleading, but I'm going to present it anyway. On one of my properties, it was previously rented in the 500s, somewhere in that vicinity, 560. It was an old lease, 3 or 4 years, and the tenant left, and it just got replaced at 850. And I was like, well, what happened there? It was an old tenancy, so it just didn't match. But this is a 2 or 3 year lag in rents that are being caught up in this one rental change. And that was quite a shock. And, people wanted to rent it at that price. So that was the market rent. So a new tenant came in and paid $850 versus, $560? Just doing the math there, it's like more than a 50% increase in rents over the last 3 or 4 years since the last rental increase that we had on this particular property, which is quite a large change. And we didn't do any work to it. Very basic fixes that you have to do, maintenance, but that's quite a large change. And it probably reflects the last 3 or 4 years. But through that process, it's getting harder to find people to rent homes at these prices because the price has gone up, the demand has fallen. That's what you'd expect.
Yeah, I think that's kind of my feel for it. Like the last time I changed rentals, like it went from, I was renting it at $850 and we left to move somewhere else and they listed it for, $1,200 and, got snapped up pretty quickly.
Yep.
But that was like, 18 months ago. And, that's kind of the rentals in that area are still about $1,200. So there was kind of that step change that's flown or, been transmitted through the market, but it hasn't really continued at pace. And like you say, if anything, it's starting to soften a little bit.
Yep.
So yeah, I can't see rents falling significantly, but it's that growth I think is not there anymore just because the stock levels
Must be migration factors.
housing stock levels aren't there and population growth is there. So I think the fundamentals aren't there to see a big drop. But maybe the step change that we've seen has kind of leveled off a bit.
Yeah. But that it's too early to tell. Essentially, we probably need a little bit more data. And that level of increase we've seen that quantum rise in rents. Perhaps that's not a sustainable rent level. Like perhaps that's not where it will stabilize. It might come down a little bit and stabilize still significantly higher than 2019 rents, but it might stabilize a little bit lower than the peak rents. That wouldn't surprise me that much. It's just the level of increase was so high and it may have been driven by temporary factors, by a huge population surge that came through when there were no houses. And now there's still no houses, but the population growth rates are a little bit lower and perhaps there's a little bit more there. Slack that's opening up.
It's a little bit more of sitting at an equilibrium rather than a big gap in supply and demand.
Yeah, exactly. The main concern around Sydney property would probably be the jobs market and see what does it look like over the next 6 to 12 months. So this is an uncertain one, but again, it's going back to those leading indicators that we said, that if there's turbulence in the job market, that's not strong. That's not good news for the housing market, particularly Sydney. One of the glues to the Sydney property price, the value of Sydney property prices is the incomes underpinning it and the incomes of Sydney-siders. And we have strong incomes here amongst the highest in the country and really strong employment markets over an extended period of time. So if that starts coming off, then it could put downward pressure on housing demand. People aren't buying houses if they're losing jobs or if they're worried about losing jobs. They don't go and feel confident to go and transact in the housing market. So that's something to think about too.
Yeah, and already we're seeing, borrowing powers and, affordability being quite stretched. So people are already kind of, using the maximum borrowing power that's available to them at their income level to, make purchases basically. And even then it's still a bit of a stretch. So if there's reduction in incomes or people losing their jobs or not being able to earn at the same income level, one, there's the uncertainty factor and the people get scared.
Yep.
But then two, it hits their borrowing power and they literally can't borrow as much to, go and buy, which puts, again, lower, downward pressure on demand, basically.
Yep. So those are the downward cases, the negative factors to consider. I'm going to make a case for Sydney property and say why it could do well over the next 12 to 24 months. Let's just say perhaps it could have another 10% in growth in that time period. That's 5% a year. Going to make a case for that and why that could happen. This case is built off interest rate cuts. We are at peak interest rate levels at the moment that suggests we have an economy that is starting to weaken. We have global interest rates starting to cut. We have a low dollar. We have a whole range of things that economically support interest rates to come down. And when they come down, we are in a setting where interest rates are too high. Not too high, they are really constraining the level of economic activity. Now, there is a very plausible scenario, a very plausible metric where you can play this out and be like, inflation comes back into band inside a year or so and continues its downward trajectory because growth has a 1% handle on it, which is all largely coming from the government sector. And the stimulus required to get the economy going again is not restrictive interest rates. It's not neutral interest rates. It's stimulatory interest rates. You need to stimulate the economy. If you take that metric, be like, what cash rate does the RBA need to stimulate the economy? They don't have any hands tied behind their backs because they're forward-looking, is no inflation problem, unemployment's beginning to rise, economic growth is slow, makes sense to cut rates, probably makes sense to have rates not at neutral. That might be the first point, get it to neutral, but then the second point might be, this isn't enough, like we may need to take it into a positive territory. You do all of these things, you'll also have APRA come in and reduce the assessment rate buffer. They have cemented it this week. They came out this week and said, we're keeping the 3% buffer because financial stability risks remain high, aka inflation's too high. That's basically what they meant. They couldn't say that, but that's basically what they meant. So take all that away, you have the change in frameworks that we've talked about a little bit. That could be that's becoming closer and closer. Every day we go further into this high rate environment, and when inflation keeps trickling down towards the band and we keep having these really tight settings, the longer we live through them, the tighter the economy is, the worse things get. And that creates the change in economic circumstances that can drive the next wave. I think if I had to guess, I'm just going to go off the month of May because that's what happened in 2019. May was the boom month where the trifecta of things happened, rate cuts, government changes and things like that. And May is roughly the time of the election next year as well. So I'm going to say somewhere in that vicinity, you could have, these big, the confluence of macro changes that could really drive the next leg of the housing market in Sydney. So today we are in this environment, and Sydney house prices haven't really done all that much over the last 6 months. We said the end of the boom was, at the end of last year. It's up 2 or 3 percentage points. Pretty much sideways movement at the beginning of this year. Not too much. It's July. Hasn't actually risen all that much over the last 6 months. Little bit, month on month. That is likely to continue for a bit longer. But these waves of change could create the next leg of this Sydney housing cycle, which if that does happen, you want to be pre-positioning yourself beforehand. So that's one case to make.
Yeah, I think, to be honest, I would kind of say that's pretty likely. You've been a Sydney-sider a lot longer than me, but my kind of experience living in Sydney for 6-7 years is if Sydney-siders can buy houses, they do buy houses. Other than like tiny little windows where they get scared in COVID or something, but like that seems to kind of hold. Is just like if they can do it, they do it. So if you're in a circumstance where borrowing powers increase by 20-30% as a result of rate cuts and, non-housing factors, there's just monetary easing that makes borrowing powers go up. I would kind of say in my limited experience, the chances of Sydney-siders looking at that and being, hey, I can borrow an extra 30%, like I'm going to go use that to make an upgrade. I think there's a pretty strong argument that historically that has happened, and I don't see why it wouldn't happen again.
And there's one more reason that I want to play out, and this is probably targeting apartments a little bit more, is the cost of building is really, really high at the moment, and the feasibilities to development are so ugly that people won't develop. Now, when you go and do that and you apply it en masse, people won't develop. Just that general concept of I'm not going to be building homes, that's going to drive a supply problem.
Yep.
We already see that in the approvals data. And if that continues, then, and there's nothing to change that for now until these rate cuts, you have...
And even then, the flow-through effect is so long, like from approvals to actually apartments on market. Like,
exactly.
Yeah.
So the affordable end, so the affordable apartment in Sydney, if you have a apartment between 3 to 15 years old in the sub 750K market, for the developers to build you competition to that apartment, to build you supply right next to it, in and around it, somewhere around it, that developer's going to pay $500,000, $600,000 to simply build that apartment. Now, call it $500,000, rough number. It makes it very, very hard for them to go and do it. So there's not going to be a supply of affordable apartments.
Yeah.
No one's going to do it. They're going to get DAs for it. These approval data that's coming through.
Yeah, who's starting? Yeah.
Yeah, starts is what matters in circumstances like this. Just because something's getting approved, we're not getting nearly enough approvals. Way too low at the moment. It's the same levels as like 12, 13 years ago when our population is 27 million today. Back then it was, 20 odd. There's a lot more people in Australia and we're still getting the same approvals.
Yeah.
12 years in, be like, that's a bit ridiculous.
But it's starts that count.
And now starts will be lower. Because, I've got lots of developments approved that I haven't started, while 2 or 3 years ago I was starting them. I'm not starting this. I can't be bothered. There's not enough.
There's no margin in it.
There's no margin in it. I'm like, I don't want to. I'll just hold it for later. Everyone's going to be doing the same. Because developers do this for profit. And if there's no profit to be had, then they're not going to do it. In the affordable segment in particular, who is going to go build an apartment? I don't understand it. You need apartments to be built up. Unless you're building skyscrapers that can drive that cost down and create even small spreads, like you can make 20 grand
Yep.
per apartment, but you're building 100 apartments,
Yep.
being like, okay, that I'm making it up in volume.
Yeah.
But when you're building 20 apartments and you're making 20 grand on them, they're like, no, that's not enough money. There's too much risk attached to that little return. So the affordable apartment market in Sydney, this is cyclical. People need these. This is the type of housing stock that people absolutely need. There's a underlying demand for this. A duplex that costs $2.5 million, that's like, it could be matching with confidence. It can move around. The apartment that's 3 to 15 years old, a lot of people, filter through towards it. A lot of new migrants need it. A lot of young people need it. It's what is affordable. It's where
A lot of people start. Yeah.
it's where the heaviest demand is. That's where it'll always have that most demand versus, a $5 million home. Sure, that may have demand, but it's not going to have 50 people lining up for it while the affordable end is. So this is a problem, and it's a problem that they're trying to fix by increasing dwelling approvals and housing supply. But just getting starts and zoning things doesn't actually fix everything. So they are trying to fix this, but it's going to take time to fix it because fixing this problem is really hard because it requires cash.
Yeah.
It requires someone to tax people less or give money out the door or come up with lower interest loans. Cash. This is the thing that governments, they don't want to do.
That isn't going to happen.
They don't want to do that.
Yeah.
Right. So, the cyclical bit here is just like, there's an opportunity opening up. It's a Sydney opportunity that's just like affordable apartments. Bit crazy, I'm saying this because, a lot of people say don't invest in apartments. And yes, if you want to follow general rules and you want to do long-term investing, don't buy apartments. I kind of agree with that. But if you want a short-term opportunity, and you need this as well because it's your owner occupier, it's starting to present pretty green signals being
For like a 0 to 5 year play where you go, okay, if let's say rates don't fall until next year, the feasibilities, like you say, for people to build apartments, that might not start looking good until 25, 26. And then people actually have to build them. So that's 27, 28. So that's kind of like your maybe a 4-year window where the supply is not going to increase and the demand is going to increase. So there's that temporary gap until there is a lot of commencements and actual apartments hitting a stock.
And you know how this gets fixed. One way this gets fixed. Demand supply imbalance gets fixed as the price rises.
Yeah.
So you make that $600,000 apartment or $750,000 apartment, $900,000. Make it 20% more over 2 or 3 years. It's fixed. Construction costs aren't going to rise that much over the next couple of years. We know that because of all the things that are happening. It's already in the index. So keep that $500,000 constant, but you've added 20%. People go start building, right? They're all going to flood to the building, be like, yes, there's money in this game. Let's go do it. They're going to cut rates. They're going to get people out there building, but it's going to happen in 2 or 3 years' time. It's going to take another 2 years to get it on. You have a 4-year window. And also, the solution to this is actually a price rise. So demand goes up, supply dries up to nil. Prices will rise. Prices are sticky. And you need the price to rise because it makes sense. It's kind of like a mispricing exists at the moment. The price of these apartments are wrong. Like, doesn't make sense. Like, why would that apartment cost less than it costs to build? It just, people want this thing, right?
Yeah.
Demand's there. So why would it cost? The numbers don't make sense here. So the numbers will just fix themselves over time. And the way to fix it is demand supply imbalances, price changes. So it's a little bit of a strange circumstance, but I have always said that data is really, really important to make decisions, but you have to look at future data, not just past data, and make some calls about what is happening and assess what the future looks like. The future of the apartment market is quite positive because of the current dynamics that exist. So Sydney will benefit from it. So now I'm talking specifically about what will benefit, and I said the West is probably doing a little bit better now. Now the West affordable apartments doing really, really well. Good opportunity. In the long run, I'm not so sure because housing supply is coming. The New South Wales government is rocketing it up. And then once it becomes profitable, everyone is going to be like, what? I can put 50 apartments here, 50 apartments there, 50 apartments here, 50 apartments there. Being like, let's go start building. And these approvals are going to go shooting up because they've...
the other end of the cycle, basically. Yeah.
Exactly. Right. So, and then prices could fall. So, could have a 4 or 5 year window for you to buy your house, buy your apartment, move into it, live in it, make some equity, sell it, move into a house.
Get out of it, CGT free, happy days.
Move into a house. So that opportunity does exist. So I think that is something to think about. don't just stick to generic rules. Apply current market conditions to your assessment and your viewpoint about what you can do. I don't think it's a bad idea to buy a Sydney affordable apartment right now.
Yeah, I'm excited by that because my fiance owns an affordable Sydney apartment. That was
How
her
old
like
is it?
first purchase. 5 years maybe?
5 years. This is a perfect example, right? And, really, really rough value.
Probably 550, 500.
Exactly.
Yeah, Homebush, yeah.
A Homebush apartment for 500. Like no one can build an apartment in
Yeah.
Homebush. Is it a 2-bedroom?
One.
One.
Yeah.
Okay. So the cost of construction there is going to be, 400. Yeah, it doesn't make sense, right?
Yeah.
Adding all the costs. So there's going to be no new supply of 1-bedroom apartments selling for 500,000 because no one's going to do that. They're going to be like, why would I do that? The only person that's going to do that is the bankrupt developer who
Yeah,
are all
yeah.
out. Like, they've all been weeded out being like, oops, stuffed that one up, made the mistake. They're all gone, right? So, that there's no supply coming online, but people who want to live in it's like one of the most central points
Yeah.
in Sydney. Everyone wants to live there. 1-bedroom apartment. Everyone needs that stock. There's going to be price pressures there, rental growth and house price growth.
Perfect. I'm excited.
Yes.
She's gonna get rich out of it. Hold that apartment for the next few years. That sounds good to me. I'm on board.
I like that. So yeah, that's our little recap of the current dynamics of the Sydney property market and a few different opportunities. What is happening on the ground at the moment? It's a little bit patchy. Is my broad summary, but there are a few different specific opportunities. Sydney is a massive market and the current market dynamics are presenting green signs in certain directions and a few red warning signs as well. We've unpacked them all to just give you a little bit of a flavor and a little bit of an update of what is happening in the Sydney property market.